Today, we're diving into something pretty wild. It's a piece of research that connects the dots between something you learned in high school physics and the absolute chaos of the stock market.
It's the ultimate question, right? Can you actually predict where a stock is headed? For years, the answer has basically been, nope, not really. But what if the secret wasn't buried in some super complex financial algorithm, but in a simple concept you probably forgot about after your final physics exam?
Well, a new study says, yeah, you can. And the key is this groundbreaking idea they're calling financial torque. The whole thing suggests that there are predictable patterns hiding in what looks like total randomness.
Okay, Section 1, a wrench in the market. Now, to really get why this is such a game changer, we first have to talk about the old school way of thinking, because this new idea basically throws a giant wrench into the whole machine.
So for the longest time, the big theory was the efficient market hypothesis. It basically says the market is perfect, all information gets priced in instantly, so everything from that point on is just random noise. But this new financial torque idea comes along and says, hold on a second. It argues the market isn't perfect. It has these little frictions, and those frictions create tiny imbalances that act like a turning force, a torque, that can actually give you a clue about where the price is headed next.
All right, Section 2. Defining financial torque. So what in the world is this force they're talking about? Let's actually break down what the researchers mean when they say torque. At its heart, the idea is actually kind of beautiful in its simplicity. It just says that if you look at where the trades are happening compared to the stock's average price, you can guess its next move. The best way to think about it is like a seesaw. If a bunch of people suddenly jump on one side, you have a pretty good idea which way it's going to tip, right?
And they built this entire theory on just two key things. First, you need a starting point, an average price zone. They use a common tool called VWAP for this, which is basically the market's true center of gravity for a stock. But then, and this is the real secret sauce, they measure the force not by how much money is moving, but by the trade count, the sheer number of individual transactions.
And that distinction is everything. Volume just tells you how many shares are being passed around, but trade count, that tells you how many decisions are being made. The theory is that 100 different traders all buying 100 shares each is a way more powerful signal, a stronger torque, than one big fund buying 10,000 shares all at once. It's crowd consensus.
And just listen to how the researchers themselves put it. This really hits home. They're saying this isn't just a clever name. They believe this imbalance in trading literally puts momentum on a stock's price, just like a real physical force. It's not a metaphor, it's a mechanism.
Okay, Section 3, the AI prediction engine. Look, a cool hypothesis is one thing, but you've got to prove it works in the real world. So that's exactly what they did. They built a powerful AI to put financial torque to the test.
They used a special kind of AI called an LSTM network, which is really good at spotting patterns over time. And here's the kicker. They only fed it those two simple things we just talked about, VWAP and trade count. That's it. The AI's job was simple. Look at these 5-minute snapshots of torque and tell us if the price of stocks like Apple or the whole S&P 500 will be higher or lower in 3 hours.
And we're not talking about a quick test over a few weeks. No way. They used a massive pile of data stretching back to 2016. And they held back the final 21 months of data, a chunk of time the AI had never, ever seen, to give it a final exam. This was about as tough a test as you can design.
So, did it work? The moment of truth. Well, let's just say the results weren't just good, they were kind of mind-blowing. This led to 3 discoveries that were genuinely surprising.
So the first big reveal, the model was just shockingly good at its job. And remember, it's a really simple model, only looking at 2 little things.
How good are we talking? Well, look at this number. For an ETF that tracks the entire S&P 500, the model predicted the next 3 hours of price movement with 87.41% accuracy. Let that sink in for a second. That's on nearly 2 years of data the model had never seen before. That is just wild.
So you're probably asking, okay, how is that even possible? Well, that brings us to the second discovery. Turns out, the AI had a secret weapon, and it was hiding where most people don't even bother to look.
What they found was that the real magic happened when they included trading data from outside normal market hours. You know, the pre-market and after-hour sessions. When they did that, boom, the model's accuracy shot up by as much as 15%. It's like all the most important clues about the day were being left right before and right after the main event.
But this third discovery, this one's my favorite. It's a complete curveball, especially if you're into AI or data science. To get these amazing results, they had to break one of the biggest rules in the playbook.
Okay, so normally when you work with AI, rule number one is you scale your data. You basically iron it all out to make it easier for the machine to read. It's just what you do. But look at this table. The best results by a noticeable margin came when they fed the AI the raw, messy, unscaled data. By not cleaning it up, the AI could see the true, explosive force of the market's moves, and apparently, that was the real signal.
So, Section 5, cracking the market's code? After all these discoveries, what does it all mean? Where does this leave us in our understanding of how markets actually work?
It brings us right back to where we started, doesn't it? The success of this model is a direct hit on that old idea of a perfectly efficient market. It's basically saying, nope, the market isn't a flawless machine. It has these little inefficiencies, these frictions. And it's in those tiny moments, before the rest of the world catches on, that these patterns, this torque, create a window of predictability.
So what's the bottom line here? What are the big takeaways? Well, for one, the stock market might not be as completely random as we've always been told. Two, the real edge might be hiding in the tiny details of trading, the so-called microstructure. Three, don't sleep on what happens before the opening bell and after the close, because it clearly matters, a lot. And four, maybe the biggest lesson of all, in a world obsessed with big, complex data, sometimes the simplest signals are the ones that shout the loudest.
You know, what this research really does is it cracks open a whole new door. It asks us to think about the market not as some abstract financial concept, but as a physical system with real forces, real momentum, and real friction. And that leaves us with one last really fascinating question to think about. If financial torque is a real measurable force, what other hidden forces are still out there, just waiting to be discovered?